Welcome to this explainer on the architecture of artificial liquidity and understanding wash trading. Financial markets really rely on one fundamental truth, and that is price discovery. But what actually happens when that truth is just a carefully crafted mirage? Today, we're diving right in to how financial markets can sometimes be an engineered illusion. We're going to peel back the curtain on a practice that distorts genuine price discovery and creates, well, entirely false volume.
So what if the market is lying to you? Think about it. When you check an asset's price on your phone, you see volume, right? Thousands, maybe even millions of trades happening in real time. And you naturally assume that represents real buyers and real sellers disagreeing on a price and exchanging risk. But what if that frantic, high-energy activity you're looking at is literally entirely fabricated?
This is what we call the illusion of liquidity. In financial crime circles, it's known as false market activity. Imagine for a second walking into this bustling, completely sold-out restaurant, only to realize all the patrons are just mannequins propped up to make the business look good. It sounds crazy, but in finance, faking volume, price interest, or market participation is incredibly dangerous. It's not economically genuine at all, and it fundamentally breaks the trust that markets absolutely need to function. It misleads participants and totally warps the perceived value of an asset. Major regulators, we're talking ESMA, the CFTC, they define this deceptive magic trick as wash trading. Basically, it's entering into transactions that create the appearance of genuine trading activity, but here is the absolutely crucial catch. There is zero real change in beneficial ownership or market risk. The CFTC specifically notes it's a scheme that gives the illusion of trading when absolutely no bona fide competitive trade has actually happened.
And this brings us to form versus economic reality. From a professional surveillance perspective, this is the core issue. Because if you just look at the raw data, the execution record, a wash trade's form is flawless. It looks exactly like a real trade. But its economic reality? Entirely hollow.
Let's break down the mechanics. A bona fide trade transfers ownership and risk between two parties with completely different economic goals. Simply put, I want to sell and you want to buy. But a wash trade, that features the exact same beneficial owner, or maybe heavily coordinated partners on both sides of the transaction. It is the financial equivalent of taking a $20 bill out of your left pocket and moving it to your right pocket. There's a lot of movement, sure, but absolutely zero risk transfer, and your net worth hasn't changed a single cent. You've completely neutralized your genuine market exposure.
As the saying goes, the trade may appear valid in form, but it lacks real market purpose. Since the interests on both sides of the transaction are aligned, or literally belong to the exact same person, there's an absence of any meaningful change in beneficial interest. It is, for all intents and purposes, a ghost trade.
Now, you might be wondering, why would anyone go through all this trouble? Trading isn't free. It costs money in exchange fees. Why pay to trade with yourself just to create ghost volume? Well, because wash trading is the engine of market manipulation. It's a highly calculated tool used by bad actors to achieve some very specific and highly lucrative goals.
Under frameworks like the UK market abuse regulation, this is treated as a severe threat to investor protection. Manipulators use wash trades to inflate reported volume, breathing this totally fake life into an asset that might actually be dead in the water. They manufacture the illusion of demand just to prop up a desired price level for massive pump and dump schemes. And getting a bit more technical, they even abuse exchange fee and rebate structures. Basically, they spend pennies on transaction fees to collect rebate bounties, effectively tricking the exchange and everyday participants out of millions.
And hey, we aren't talking about old-school 1920s stockbrokers passing paper tickets back and forth on the trading floor. In today's highly fragmented, lightning-fast electronic markets, this threat has been totally weaponized. Fake volume isn't just tricking human investors anymore. It's designed to bait high-frequency trading algorithms. An algorithm detects a massive volume spike in a fraction of a second, assumes there's a legitimate breakout or a big news event, and automatically jumps in. So the algorithm actually ends up doing the manipulator's work for them by artificially driving the price exactly where they want it.
If you think this is some solved historical problem, think again. The U.S. derivative space is currently a massive battleground for this. The CFTC has been absolutely relentless, issuing major wash sale enforcement actions involving non-competitive transactions all throughout 2024. And that aggressive momentum, it's carrying straight into 2025. This typology is current, it's escalating, and it is sitting right at the very top of regulatory watch lists.
All of this creates a massive headache for compliance teams and regulators. How do you catch a phantom?
The ultimate challenge here is that a wash trade is almost never obvious in isolation. Because the form is perfectly structured, a single flag trade looks exactly like normal market activity. You just can't look at one single piece of the puzzle.
To actually pierce the illusion, mature surveillance frameworks have to act a lot like forensic detectives. First, they don't just blindly look at the trade. They question its commercial logic. Does this transaction actually make business sense? Then, they dig into the risk transfer to see if it truly changed hands. Third, they heavily scrutinize the counterparties to verify that they are genuinely independent. And finally, they have to zoom out, hunting for wider manipulative patterns. It's really about spotting the forest, not just staring at a single tree.
Pulling this off requires monitoring a massive, totally interconnected web of data. Investigators have to pierce the corporate veil to map true beneficial ownership. They have to align account relationships, exact millisecond timing, and pricing data to catch those repeated patterns of self-matching. As ESMA heavily emphasizes, when related parties repeatedly transact without real economic change, the system has to instantly connect those dots, flag the behavior, and escalate it directly into suspicious transaction reporting.
Ultimately, wash trading fundamentally corrupts the ecosystem. It undermines the very integrity of the system by manufacturing a reality that simply does not exist. So the next time you see a surging asset and a tidal wave of frantic volume on your screen, it's definitely worth asking yourself one vital question. If the volume isn't real, what else is an illusion? Thanks so much for joining me on this explainer. Keep questioning the data and keep learning.